All right, good afternoon, folks. How's everybody doing today? I hope this workshop finds you well on this beautiful Sunday. It's starting to turn a little bit towards fall in California here, so it's been a little bit overcast today. I hope it's staying nice where you're at. Last weekend we were gone because my wife and I were over in Zion National Park, and let me tell you, if you have never been to Zion National Park, I highly recommend you go. With everything being as shut down as it is, you can get outside, get some fresh air, and it was just absolutely breathtaking. The pictures do not do it justice. So I would definitely recommend checking that out if you have some time that you're trying to spend, and maybe your vacation got canceled like mine. We were supposed to go to Thailand, and we should have been there actually right now this week. But with everything going on with COVID, the flights are shut down. It's just not really safe to go. So we decided to take more domestic trips to try some things out. So Zion National Park was absolutely amazing. And we're going to go to Florida this next weekend. So for those of you in Florida, hopefully you can keep that nice weather. Things look like it's going to be really good there. So hopefully we have a great week, and we'll be over on the, I guess it'd be the West Coast near Tampa, Clearwater, St. Pete. And then we'll spend a few days over on the East Coast, over in near the Fort Lauderdale and Miami area. So checking out the whole area and just seeing what it's like over there this time of year. Hopefully it's not too bad. As we are getting logged in, or actually before we do, let me introduce myself. For those of you that are new here, my name is Jason Hamilton. I'm the founder of this group and this page. And generally every Sunday around 2 o'clock Pacific time and 5 p.m. Eastern time, we're going to bring you a workshop that's going to teach you some sort of knowledge about helping you master your retirement journey, whether you're getting prepared for it or whether you're already in retirement and you want to get better at optimizing what you're currently dealing with. So today we're going to talk about some taxes and retirement. But before we get going here, I'm seeing some people are still logging in. So I want to take just a minute here and ask you a question today. And I like to do this each week. What are you grateful for today? So if you can put this in the comments, I'd really appreciate that, because I think starting our day, and I recommend you start every day, that with gratitude, and that you take the time to remember what you're grateful for. There's a lot of chaos going on in this world. We're going through a huge shift in everything here politically, but we're just going to get all that out of our minds for today. We're going to check out for about 20, 30 minutes here on this workshop and just focus on gratitude. And we're going to focus on what's not going to change regardless of, who gets in the White House, which is going to be, we're going to have to pay taxes, right? And especially on Social Security, this is not something that's really come up on either tax plan. So I'm pretty sure this is going to stay through what I teach you today. So the rules we talk about today have been in place for quite a while. And, I want to definitely second Chris. So Chris said, I can't tell if it's his or her, the picture is a little bit small, but good health, right? If you have good health, I think that is something very special right now. There's a lot of people that have not experienced quite good health with COVID going around. So if you've been healthy, you've stayed healthy, I think we can be really grateful for that. Twyla says, grateful for family. Absolutely, Twyla, I agree with you. That's the same thing. I feel very grateful for that. And I get to go back and see some family for Christmas. So I'll be back in Northern California for that. Vicky says that God is ahead of her life. Absolutely beautiful, Vicky. Thanks for sharing that. Brenda says a beautiful sunny Sunday in Connecticut. Awesome. Well, we're overcast and I'm in California, so maybe you can get some of that weather back over here shortly. Judy said family. Craig said married for 38 great years. Congratulations, Craig. 38 years is amazing. I would love to know your secrets. I'm coming up on year 4 in May here, so that's it's a start, right? And Joan says friendship. So thank you, Joan. Thank you guys for sharing that. We appreciate that. And like I said, today we're going to talk about Social Security taxation. I don't think it's a little bit complicated, I would say, in a sense. But there's a big percentage of people that are not going to have to worry about this at all because they're not going to be taxed on their Social Security. But for those that are, this ties in a little bit with our Social Security claiming decision we've been talking about in the last couple of workshops. So if you haven't caught the last couple of workshops, please go back through the archives. If you're in the Facebook group, it's called Your Retirement Coach. If you go to the announcements, under the announcements page, there's all kinds of content there, a bunch of videos for you to go through and learn. If you're watching this from my Facebook page at Jason J. Hamilton, Financial Planner, please ask to join the Facebook group, Your Retirement Coach. There's some excellent conversations going on in there, and there's a lot of information where you can learn, and vice versa. If you're only in the Retirement Coach group and you haven't followed or liked my page on Facebook, it's Jason J. Hamilton, Financial Planner. and you can find it at Retire Simple. I recommend that you follow and like that page so that way you can receive all information, receive notifications, and you'll be able to follow along live as we go live every Sunday. So we would love for you to join there and follow us. So, but today we're going to dig into some of this taxation, and I'm going to try to make it simple, okay? But one thing we need to think about when we are getting ready to transition to fund our retirement, okay? Social Security is generally the foundation for the majority of Americans' retirement. It was only designed to replace about 40% of your retirement income, but for many people, it's replacing 80 or 100% or sometimes more of your retirement income. And obviously for some people, it's much less than you really need. But one thing we need to think about is, what are you going to actually receive, right, from your Social Security benefit? Because maybe you plan to receive, $2,000 per month, but if you have other income sources coming in that are going to be above the limits, which we'll talk about shortly here, then you might only actually receive, $1,750 or $1,800 that you actually get to use because of the taxation, that might be involved in that. So as you're building out your retirement income plan, you want to make sure that you know exactly what's going to be coming in after taxes so that you can know what you're going to have to be able to actually pay the bills, that you need to pay. So same thing with your IRA or 401k distributions. You want to look at what you're going to actually receive after taxes so that you can know what sort of cash flow you have to, design your ultimate retirement life with. So let's talk about that a little bit today. And I'm going to jump right over to our workshop here. So let's see here. All right. Okay, where did that go? Let's see. There we go. Excellent. Okay. So today we're going to talk about what is or how does taxation of Social Security benefits work, okay? So I'm going to walk you through here. This will be a relatively short presentation. I'm just going to address only this subject because I want you to have some solid takeaways that you can use and actually have the formula that if you're doing this on your own, that you can use to calculate. And of course, I'll put my website info at the end. If you need help with any of this stuff and figuring out your tax situation when it comes to retirement, we're happy to help you out with that. So let's dive right in here. And before we do, I need to just let you know that everything I'm giving you today should not be taken as financial advice, legal advice, tax advice, anything like that. This is for educational purposes, okay? So I have to be real careful here, but I put up my disclaimer every week just to make sure that you don't try to come sue me because this is just educational, okay? So this I found interesting, and maybe you will as well. But about 70% of Social Security recipients pay no tax on their Social Security. So what that means is they're below the income limits for what would qualify as Social Security taxation income limits, and we'll talk about that in a moment. About 15% are taxed at the highest possible rate on their Social Security. So it doesn't mean that 85% of your Social Security is going to be going away. It just means that 85% of your benefit will be taxed at your particular tax rate. Okay, so about 15% of people are taxed the full amount that they can be taxed on Social Security, which is 85% due to their high incomes. And the final 15% are in the middle income range, and the tax on benefits is starting to phase in. Okay, so we're going to talk about this specifically, but there's really two levels of Social Security taxation. But Social Security benefits are subject to taxation only if the worker's total provisional income exceeds certain thresholds. So for a very detailed explanation of this, you can see the IRS publication 915 if you'd like to look that up. But I'm just going to give you the direct formula to make it a little more simple. So here is how provisional income is calculated. Okay, so if you're new to retirement and retirement planning, your head just might be spinning. Okay, and there really is a lot to know about getting this right, and that's why I do recommend working with a retirement planner. But there's some things here that you can start doing for yourself as well if you're looking to prepare for retirement and you want to try to get some numbers in order, okay? So provisional income is a special type of income calculation that really determines whether your Social Security benefit is going to be taxed or not. That's the main purpose of this, but it's called provisional income by the IRS. So the way that works is you're going to take your adjusted gross income, so excluding Social Security. So your adjusted gross income for retirement might be something like earned income, if you're still working a job or a part-time job, for example. It could be pension income, okay? So pension income is accounted as part of your provisional income. It could be rents you're receiving, if you have rental properties. Could be dividend income, that could be part of it. And it can also be withdrawals from your IRAs, 401ks, TSPs, 403bs, whatever type of accounts that you have. So if you have a pre-tax retirement account like a 401k or an IRA, and you take a distribution, that is going to be income to you in the year that you receive that distribution. Okay, so you're going to add up all of your income sources, and that will be your adjusted gross income. Okay, so AGI is another term for that. The second thing you're going to add to that is any non-taxable interest. So one example of non-taxable interest is muni bond interest. So muni bonds can be great because they are, the interest you receive off of them is not taxable. So muni bonds can be really good for investment money that you have that is not in a tax sheltered account, like an IRA, Roth IRA, 401k, 403b. So if you have bonds that are outside of your protected accounts like IRAs, muni bonds can be a good way to go. But in this case, if you do receive interest from your muni bonds, that is going to be counted in this particular calculation. So that's called non-taxable interest. Okay. And then the third factor is you're going to add 50% of your Social Security benefits. Okay. So if you are receiving $2,000 a month, which would be $24,000 a year, then 50% of that amount would be $12,000 in this case that you would add to this formula. And that you add those three up together and you will get your provisional income. Okay. Many people don't have any non-taxable interest, so a lot of times it's just their AGI and half their Social Security benefits. But this is the proper formula, so this is what you'll use to follow. Okay. And I'll mention as well, if you have questions along the way, go ahead and put them in the comments, and then I will do my best to address them once we wrap up here. Okay. So depending on your provisional income, you could pay tax on up to 50% or even 85% of your Social Security benefits. Okay. So what that means is up to 50% or even 85% of the income you receive from your Social Security benefit could be added to your income for tax purposes, which means you would have to pay tax each year on that and have to either plan for it by paying quarterly payments throughout the year, or you can elect to have a portion of your Social Security benefits essentially put into an escrow account that can be used for taxes at the end of the year. Okay. So if you're below certain limits, you're not going to pay any tax on your Social Security benefit. So this is one of the big benefits of doing tax planning is that we can get your tax situation in a place where your income is very low, especially later in retirement. Even if you have to pay tax on your Social Security benefits early in retirement, there are ways to get your income to be 100% tax-free or at least very low tax, so that you don't have to pay tax on your Social Security for the rest of your life. But these numbers have been set in stone quite a while ago. I think it was back in like early 2000s. And these numbers are not indexed for inflation. Okay, so what that means is you're going to pay tax on a little bit more of your Social Security benefits each year, which is kind of a little bit of a pain in the butt there. But their benefits will be tax-free if you're a single filer or head of household filer. If your provisional income is less than $25,000, okay, and that's per year. If your provisional income is less than $25,000 per year and you are a single or head of household filer, you will pay no tax on your Social Security. For those that file a joint return, if your provisional income is $32,000 or less per year, then you will pay zero tax on your Social Security benefit. Obviously, the opposite is true as well. If you're above these amounts, then you will pay some sort of tax on your Social Security benefit. For single filers, if your provisional income is between $25,000 and $34,000 on a single return, or $32,000 and $44,000 on a joint return, for every dollar of income between the lower and upper bases of these ranges, 50 cents of Social Security benefits become taxable, up to 50% of the total benefit. Okay, so this is where it gets a little bit tricky. So it's the amount of money in between this range you're gonna pay 50 cents on that if your income is between this range here. Okay, and I'm gonna do some examples. So if this doesn't make sense yet, bear with me. I have a couple examples for you, and I think this will answer your questions. Okay, but if your provisional income exceeds $34,000 for singles or $44,000 for married couples, then for every $1 of income above these thresholds, 85 cents of Social Security benefits become taxable, up to a total taxable amount of 85% of benefits. Okay, but regardless, of the level of your income, of your provisional income, 15% of your benefit will always be tax-free, and that's for now. Okay, so we'll say always until there's a change that goes through. I really hope they go the opposite direction and stop taxing Social Security benefits, but who knows if that's the case. So, for a lot of people actually live under these limits once they get their houses paid off, and if you live in a low cost of living area. If you're in a high cost of living area like California, New York, those type of areas, most likely you're going to be above this and have to be paying tax on your Social Security. But 15% of it will always be tax-free. So this is where it gets a little interesting when you think about whether you should delay Social Security or you should take it earlier, because if you the more Social Security income you have, if only 85% of that can be taxed, that's a little bit beneficial versus having to take an IRA withdrawal, for example, that will be 100% taxable, right? So these are things you really want to be working through some numbers on when it comes to planning for your income streams coming in for retirement. Okay, and as I mentioned before, these thresholds are not indexed for inflation. Okay, so what that means is these don't go up a little bit each year. I really wish they would, okay, because that would really help out my clients with paying less taxes, but currently they are not indexed for inflation. So that means more of your Social Security benefits are taxed each year due to cost of living adjustments. And then also, possibly more money you have to take out of your retirement accounts. And that could be due to just increased need or your required minimum distributions, which start at either 70.5 if you started taking your RMDs before 2020, or now it's 72 and later if you turn 72 in 2020 or beyond. Okay. There are some states that do tax Social Security benefits, but most don't. So the majority of states do not tax Social Security benefits, but there are 13 that do. Many of them follow right along with the formula I just shared with you, about 50 or 85%, but some have some slight variances. But if you're in one of these states here, then you will possibly be paying some tax, not only on a federal level, on your federal tax return, but also on your state tax return. So it's kind of annoying, right? So this is all money you need to plan for, though, because what you're going to be paying your bills with is your net income, so your after-tax income. So if you have taxation happening on your Social Security benefit at the federal level and on the state level, well, that's going to require you to take more money possibly out of an account like an IRA or 401k, which means more taxes there too, right? So taxes are definitely probably one of the biggest challenges, I think, for retirees to really get their situation worked out. And you really want to plan for this to make sure you have enough. And then that's going to go along with your overall investment strategy, because we need to make sure your investments are going to keep up over time after taxes are taken out for government and state purposes. Okay, so we're going to have an example here. Okay, we'll do an example with Bob and Rita. In this case, Bob and Rita have an AGI of $28,000. So what that means is they're either taking a $28,000 distribution from their 401k or IRA, or they have an income source that's bringing them in $28,000. They also have municipal bond interest of $1,000 per year. And they have Social Security benefits of $22,000 per year. Okay, so those are their three income sources that they're using to fund their retirement. It's a total of $51,000, I believe that is. And this is how the provisional income works, okay? So even though their total income is $51,000, we only need to worry about provisional income at this point, okay? So provisional income is the formula that I mentioned before. So it's your AGI, so you can use the full amount. So in this case, it's $28,000. You're going to add the municipal bond interest. So in this case, it's $1,000. But for the Social Security income, we're only going to use 50% of that benefit, right? So in this case, they had a $22,000 benefit, so we'll use 50% of that, and that will be $11,000 of that will count. Okay, so when you add those three up, that gives us a provisional income number of $40,000. Okay, so their provisional income is $8,000 above the $32,000 low end range of the threshold for a couple that files their taxes jointly. Okay, so they have breached the level where they are going to pay some tax on their Social Security. So how does that work? Okay. So in their case, up to 50% of the benefits are taxable between $32,000 and $44,000 for those married filing jointly. 50% of $8,000 is $4,000. So $4,000 of the benefit will become taxable, right? So they're receiving $22,000 of Social Security income. $4,000 of their benefit in this case will be taxable. So that's basically where they're sitting. So it's not as bad as you think, unless you have somebody that's still working and maybe earning $70,000, $80,000, $90,000, then this number can become a lot larger. But because their income is on the lower side, it's not as bad as you might think. Okay. So now we have example number 2. So example number 2 is Peter and Faye. So Peter and Faye, married couple again, they have an AGI of $60,000. Okay, so their gross income is $60,000. They have no municipal bond interest in this case, but their Social Security benefit is a bit larger. Those Social Security benefits $42,000 per year. So what does that look like for taxation? We're going to take their $60,000 for their AGI, the whole amount there, and we're going to take 1/2 of their Social Security benefit, which is $21,000 now. We're going to add those together, and that will give us $81,000 of provisional income. Okay, so they're going to be bumped quite a bit higher. So in the $32,000 to $44,000 range, 50% of the benefit amount is taxable. Since the range is $12,000, 50% of $12,000 is $6,000. So they'll be taxed on $6,000. They are $37,000 above the $44,000 top of the 50% threshold range. So 85% of the $37,000 is $31,450. So in this case, we're going to be looking at $36,000 plus $31,450 equals $37,450, which is their potential taxable amount. Okay, and so we need to make sure that this amount is no more than 85% of their total benefits. So this is where it gets a little bit tricky. And honestly, I just think using tax software is the easiest way to figure this out. But I want you to understand the underlying calculations for how this works so that you understand where everything's coming from, because it might not make total sense to you. Okay, so let's take a look at that. So if we took their Social Security benefit of $42,000, that's their total amount, and we multiply that by 85%, that gives us a number of 35,700. So this is the maximum amount that can be taxable, and it is lower than the 37,450 we arrived at using the other calculation. So in this case, 35,700 is the tax amount for Peter and Faye. So that's the amount they're going to have to pay tax on, and that will be added to their AGI to figure out what their total tax liability will be. Okay, so any questions on this? I'm not seeing any questions come in so far. So if not, then I'm going to move on. But if there's questions, go ahead and put those in. Okay. So we'll talk about this for a second. But if this is something that you would like help planning with, and really just taxes in general, this is what we do, right? We'll help you plan your income streams, your taxable income. We'll give you an accurate assessment of what you're looking like pre and post retirement. We'd love to speak with you about that. And if you'd like to schedule a call to discuss your taxes before, during, or after retirement, we'd love to speak with you. And you can go to my website here at keepitsimplefinancial.com to schedule your initial consultation. Okay, so I'm going to put the link in the comments as well. There are a couple questions that came in, so let me go back to my other screen and we'll address those here. Okay, so Cindy has a question here. So besides a pension, I have a savings bond from a previous job. They are beginning to mature. Are they also included as a source of income? So Cindy, I need to know what type of bonds they are, because if they're like zero coupon bonds, for example, which means you've not received any sort of like interest or coupons throughout the time you've owned the bonds, and you're going to receive it all when the bonds mature, then I would say yes, that's going to be included as a source of income. So you would want to consider that in your planning. Okay, Sergio, this is a good question. So what about those living or planning to live abroad? So if you live abroad, you're generally still going to file a U.S. tax return. So this would be something to consider. If you have like dual citizenship, and this is not my specialty, by the way, so if you need a specialist here, I can refer you. But if you have dual citizenship, or maybe you have, like, let's say, a pension from another country, that can actually impact your Social Security payments that you receive. So, there's some things there to consider when it comes to that. But, there's a whole multitude of other issues there. So this isn't going to be exactly the best training for you, but I would definitely work with somebody who specializes in cross-border planning so they can help you with your particular planning scenario. So good. Well, that's all the questions I'm seeing today. So Once again, if you would like to speak, go to keepitsimplefinancial.com/talk. And I'd be happy to set up a call with you. I think we're booked out now until November, so if you want to set up a call, I'd highly recommend you do that earlier than later. I will put the link as well to our calendar page down below in the comments so that you can set up a time to speak. But other than that, that's what I have for you today. A real short training. Hopefully you took a good key takeaway away from this. And if you are looking at planning for retirement, like I said, and you think you're going to have above that $25,000 or maybe $34,000 income range for your provisional income, there are some planning tips and tactics you can use to alleviate yourself on these taxes, especially later down the road in retirement. So this is what we do, what we specialize in, so we'd love to help you out with that. And other than that, I'm going to wish you a wonderful Sunday, and we'll see you on the next call, okay? So have a great day, and if you need anything at all, send an email, set up a call, and we'll be happy to chat with you, all right? Until next time, we'll talk to you then. Bye-bye now.